Hi, my name is Richard Fox, and it's a pleasure to be speaking to you today regarding the course that hopefully you can see in front of you, Invention to Venture, Workshops in Technology Entrepreneurship. I'm doing this for the 3ND. I've taught at New York University for over 30 years now, but I usually teach to a class and I don't teach to a computer, so I apologize if I hem and haw a little bit as we go through this. But I think you'll find the next 3 hours should be very interesting. I've been a VC for now over 20 years, and I've seen almost every deal that you can imagine come through me. I've looked at thousands and thousands of transactions and investment opportunities. Venture capital is a very difficult asset class, and we'll talk about why it's a difficult asset class. The disciplines you need to approach venture capital are many. One needs to be analytical, one needs to be understand technology well, one needs to understand people well. I would say that is absolutely key. One needs to understand how to present a transaction to your partners and develop the transaction. One needs to have a very significant network to get the right people in the right slots to do the position. And then last but not least, there's always a certain amount of luck involved, particularly with respect to the timing of how a deal gets done. So there are so many intricacies and facets of venture capital. I hope to present in the next 3 hours what I can. And I hope that you'll be able to ask some questions, which we can answer over the allotted time. I teach this course with an idea of presenting a lot of different concepts. So I'm going to go fast, and given the fact that it's a mobile lecture. You're not going to be able to slow me down and ask for time, but take notes. If you have questions, I would be pleased to answer. I always describe my career as going down the balance sheet. I started as an international banker in New York with the Chemical Bank, and I was given charge of Central America when I got off the training program, and it was at a time when all of the Central American countries started defaulting. So I learned one thing that I've learned, that I've taken with me through my career, which is it's a lot easier putting out money than getting the money back. So I think that's totally applicable in venture capital. It's a lot easier putting out the money than getting the money back. And we have bosses too. We have investors, we have institutional investors, family offices, people that fund us, insurance companies. So we need to make sure that we do enough to get back a multiple of their investment. And most institutional funds look for 3 to 4 times minimum what they've invested in this asset class. So without further ado, let's go through the PowerPoint. I'm going to go slowly and try to go through all the concepts, and I apologize again if there's some issues with continuity, as this forum is somewhat new to me. Okay, so on our first page we have a cartoon that says two cavemen are talking. It says, "I call my invention the wheel, but so far I've been unable to attract any venture capital." And I thought this was a very interesting cartoon, because it is absolutely true, which is that there are thousands of tremendous discoveries out there that were not able to get venture capital. Technologies that are sitting on a shelf, technologies that could cure cancer, technologies that could cure a host of illnesses, technologies that could make our life easier, but never saw the time of day because it failed in attracting the right kind of financing or venture capital into the area. So So what is venture capital? For those of you who are in the United States who followed the election, there was a lot of discussions about Mitt Romney being a venture capitalist, or was he? Or was he a vulture capitalist? Or was he a private equity guy? Well, there are very significant distinctions in what I call alternative assets. Certainly private equity. And when I talk about private equity, I talk about management buyouts. I talk about purchasing large companies that have cash flow, perhaps thousands of employees. That's private equity. Sometimes you take a public company and you go private with it. So that's going on right now with Best Buy, as the founder is looking for a way to perhaps take the company private again from public shareholders. That to me is private equity. It's large, it's big, the funds are huge, they're billions of dollars in capital. And Bain Capital, although I think there was somewhat of a mix, was more of a private equity firm. So if one talks about Mitt Romney, I would talk about Mitt Romney in terms of being a private equity person. A venture capitalist is one segment of the alternative asset universe. And it's a very different segment than that of private equity. Much of private equity deals use leverage. They use debt as leverage. So many times companies get purchased by tremendous amounts of debt put onto the balance sheet. And venture capitalists, for the most part, we don't use debt. And the reason for that is that we don't have any collateral to offer banks. Maybe we have some debts, we have some shares, and we have some technologies and some ideas, but we're not overly bankable unless we get the company going. And that is why a lot of companies like Microsoft and Apple, to a lesser extent Intel, they do not use any debt on their balance sheet. Even though Microsoft is such a huge company, you see an extremely minuscule amount of debt on their balance sheet. Same with Apple. And the reason is somewhat cultural, is that the technology companies grow using equity. They don't normally use debt. And even though the cash flow characteristics are phenomenal, particularly for Microsoft, phenomenal for Apple, I have never seen them really leverage up their company in any significant way. Maybe that'll be in the future. Maybe a private equity group will come along and start trying to purchase technology companies and leverage them. As of today, if you look at most technology companies, they're very low on debt and have a significant amount of equity. So venture capital grows using equity. They grow from small companies into large companies. Google certainly was a venture-backed company. Facebook was a venture-backed company. Microsoft was a venture-backed company at one time. There was one venture capitalist in Microsoft. So all these companies started as venture capital-backed companies and then grew from there. So I've put on here a history of venture capital. And venture capital really started after World War II. And it started in a number of ways, but it grew very, very slowly. And I have here, founded in 1946. Digital Equipment Corporation out of Boston was a recipient of some of that first capital. And it was really around the fact that computerization really started after World War II, albeit it was a very slow progression. What we see in terms of venture capital, it really started coming on in the 1960s and in the 1970s. And the center of it was a little area in California, south of San Francisco, called Silicon Valley. And IBM set up offices there. Very early companies like Fairchild Semiconductor. All of these companies had operations in Silicon Valley. And that became kind of a hub of where venture capital started. But before I go further, I want to take an aside here to talk about what are the needs of venture capital. Why do some regions do very well with venture capital and other regions don't? I've always found this interesting. I don't have any exact precise answers for it, but I think I have some thoughts on it that might be interesting. Silicon Valley has a lot of interesting facets that I think made them a center, of the venture capital universe. One was the very foresighted technology transfer policies of Stanford University, and maybe to a lesser extent the University of California at Berkeley. The fact that Palo Alto and Stanford University is right in the middle of the venture capital universe, and that it's a great engineering school, I think had a lot to do with the requirements that made venture capital begin to launch. And the capital began coming around the technologies and the engineers in that area. I mean, if we look at venture capital today, there's really, there's quite a few areas in the world of which are great venture capital. The first is Silicon Valley. The second is Israel. The third is Boston, Massachusetts, and 128. And the fourth may be Austin, Texas, and there's certainly a very significant venture capital universe in the Washington, D.C. area, as well as the New York area, and some in Philadelphia, but not as much as in the other areas. Those are the venture capital centers in the world. Certainly Ireland, back in the turn of the decade, the turn of the century, had a very significant technology aspect to it, and it still does. And there's been a lot of new centers that have opened up, certainly in Russia and in Eastern Europe in certain areas. But the centers, again, all have certain facets, certain things that I think really make for great venture capital. And one is this very odd type of Geist, which is entrepreneurship. And entrepreneurship is a very interesting cultural thing. You see so much entrepreneurship in the Silicon Valley area. You see it in the Boston area. You see it in Israel. You see people who are looking to create that great next idea. And there's always intellectual capital nearby. In Israel, it's Technion. There's other universities in Israel that really support the entrepreneurship. And again, we talked about in Silicon Valley, there is Stanford University and there's Berkeley. And then in Boston, you have MIT, you have Harvard, and other educational institutions. So almost all the time, almost always, I see there are the same features in areas that promote venture capital. And they all have to be working together. Interestingly, in the Philadelphia area, we have a lot of those things, and I'm from Philadelphia. We have tremendous universities, but we don't have the same kind of technology transfer policies that made for a great venture capital area like we had in Stanford, or excuse me, in Silicon Valley. So the next thing I want to point out is that venture capital was also augmented significantly by the 1979 Employee Retirement Income Security Act, which is for short called ERISA. And it allowed pension funds to invest in private equity. So pension funds became a great driver of venture capital funds, given that normally 5% of a pension fund's assets would be invested in alternative assets, including private equity, venture capital, real estate, other types of alternative assets like forestry, etc. So 5% of these large pension funds could be used for higher risk investments in those areas. And that really was a tremendous spawn to the venture capital universe. Traditionally, venture capital had been funded by insurance companies and private equity. By insurance companies and endowments. A lot of university endowments had very significant contributions to the early venture capital funds. But the early venture capital funds were, they were $20 million, $30 million, $40 million. They weren't the hundreds of millions or even billions of dollars that they are today. So a lot of the venture capital fund development came about as a result of these changes in how to operate a pension fund. Okay, with that, let's go to page 5, and what is venture capital? And I put in here, venture capital is raised pools of capital from institutional, state pension funds, insurance companies, family offices, and individual investors. Many times, what's the right size of a venture capital fund? I don't know. There's all kinds of different sizes, and there's all kinds of different venture capitalists today. Many venture capitalists have moved to what we call late-stage venture capital. That's very different than early-stage venture capital. But the traditional model was that a venture capitalist would put up $1 million or $2 million, maybe $3 million to get a company going. And now the funds have gotten so big that making those type of small investments for the bigger funds is very hard. So there's been some bifurcation overall in the fund sizes. A lot of funds have become very large funds looking for large opportunities. And then there's a great many number of emerging funds which are smaller in size but are more like the traditional role of venture capital, which is offering 1 through 3 million, and then of course reserving for future rounds. Raising capital for venture capitalists is very, very difficult, because essentially a venture capital partnership is a blind pool of money. So why would anybody invest in a blind pool of money? Well, you've got to have tremendous confidence in the team and in the partners who you're giving the capital to. So, the traditional funds like Kleiner Perkins, Sigma Partners, Sequoia, Benchmark, all of these funds have a lot of institutional money following them. And raising money for that area is not as difficult for other funds who have to go out and convince people that to invest in their blind pool with their strategy and their network. That's a harder sell. So raising a venture capital fund is not a small undertaking, and it's very complicated. Venture capitalists finance new and rapidly growing companies. That's clearly what we try to do, and we have, like I said, we have many bosses. Our bosses are the institutions that invest in us, and they want 4 times our money. So when a new company comes into us, my view is, can we make 3 or 4 times our money at least on this particular transaction? What about this company will get us 3 or 4 times our money? So, but suffice it to say that we finance new and rapidly growing companies, and we finance them usually on an equity basis, not on a debt basis. As such, we go on the boards of the companies. We are usually very active with the management of the companies, and that is another that's a balance that has to be achieved by venture capitalists working with their management. It is very clear that venture capitalists should not micromanage their managers, but that they should assist them with the network, with the strategy, with other new financings that the company may need. The support given by a VC is extremely important to the entrepreneur. And in many ways, the venture capitalist relationship with their entrepreneurs is akin to a marriage. It's as intense, maybe even more intense than many marriages. So picking the right people is extremely important. This is not third-party capital. This is not money you're going, giving a loan to, expecting repayment with interest. This is every day. These are disagreements. These are things that have to be hammered out between the VC and the entrepreneur. It is a very close relationship. And if it begins breaking down, then the company stands a high chance of also breaking down, as the company is financially dependent on the venture capitalists to move forward. Usually, a venture capitalist purchases preferred equity securities. The preferred equity securities do a couple things. One is they put them usually above the management shares, and we'll talk about that as it relates to bankruptcy law, etc. It also allows the venture capitalist to put in control features like who's going to be on the board, and you can do that with common stock. But with preferred, you can also put in redemption features, which that the company will have to come up with the money to redeem the preferred stock in 5 years. You can put in anti-dilution language. So usually the preferred, if you will, pun, the preferred form of financing is preferred equity securities. And almost always the venture capitalist takes a or a number of positions on the board, and is a big part of making that company go forward and ultimately either become successful or not. Venture capitalists add value to the company through active participation. We just talked about that. And take higher risks with the expectation of higher rewards. And for the most part, have a long-term orientation. I've always found that the problem investing in venture capital is you can be right about the technology, you can be right about the management, you can be right about all of these things. But if you're not right about the timing, that can really be a huge problem. So most venture capitalists understand that they're going to be in the transaction for a while. And certainly not every deal goes like this. There's not a, even though the projections are hockey stick, the number of companies that are able to do a hockey stick are probably less than 2 or 3%. And there's always unforeseen events. Therefore, venture capitalists need a much longer term horizon in the way that they view this investment. Usually, venture capital partnerships are from anywhere between 8 to 12 years. Usually, VCs put out the money in some kind of equal amounts every 5 years. They put out the money in the first 5 years with the idea that the next 5 to 7 years they will harvest those transactions. So many times if you make an investment, you get an immediate payoff. That's the best kind of investment. But I would say that the majority of venture capital investments are invested and liquidated somewhere between 5 to 8 years. So you can see the long-term horizon as a result of venture capital investment. One of the other sides, as an aside, one of the other issues with venture capital investment is that years ago, in fact, when I started in venture capital, you were able to take out companies that had 10 to 15 million in sales through an IPO. There were many second-tier and very good third-tier names within the investment banking areas that you could take these companies out. No, you can't do that anymore. And the reason for that is that investment banks will only look to take a company public, I would say today, at a minimum of $50 million. So the job of the venture capitalists has really changed. The years ago, we needed to get a company from, say 1 million to 10 million, and then we would have liquidity options. Today, we're looking at taking a company from 1 million to at least 50 million. So the expertise and abilities of both the VC and the management have to be much different than they were 20 years ago in order to find liquidity mechanisms. All this is a long way of saying that venture capitalists simply by the kind of companies they're investing in, must take a long-term orientation or horizon on their investments. Many times it takes more than 10 years to really get a company to a point where you can either sell it through a trade sale or you can have an initial public offering done on the company. And many times, if you can't get there, you have what I call kind of zombie companies that can either be trade sale, to accomplish a trade sale, or an IPO. So it is a very difficult situation. So these companies, many of these companies will have 6 million in sales, 7 million in sales. They are slightly profitable, but they have no exit. They have no way to get out. So, venture capitalists are constantly trying to figure out what to do with these companies or how to advance the bar forward. And many times advancing the bar forward means that they need more capital. And putting more capital into a very uncertain situation can be a very scary thing. So we'll talk more about that as we go forward. And as we talked, usually if VCs make their returns via merger and acquisition, I mean, you would love to make an investment and then sell to Apple 2 months later for $50 million. So, make $2 million investment and then sell for $50 million. Those are very few. Those are very hard to get. But certainly trade sales represent a very large liquidity mechanism for venture capitalists. And usually the people they're selling to or the companies they're selling to are larger technology companies. Initial public offerings are in many ways preferable to trade sales, but in some ways they work hand in hand. Because if a company is on a track for an initial public offering, it can certainly argue that the value of the company is higher in a trade sale. So many times companies will do this dual path. One of the problems with initial public offerings is that the underwriter usually imposes a lockup. That lockup can go from 6 months to 2 years. And a lockup means you really can't do anything with the stock that is a part of the public offering. So that is a problem for many venture capitalists because they are powerless to do anything with the stock, and if it starts going down or if it rapidly goes down, there's very little that you can do about it. So many VCs would prefer going on an IPO track, but then selling, for 90% cash and 10% earnout or something of that nature to a large technology company. But the currency really is set, the valuation's really set by the initial public offering. I hope that makes sense. If it's a complicated area, but certainly open for questions if you have any. Okay, so let's turn now to the VC industry sub-segments. Essentially, venture capital is divided into two areas: technology and life sciences, and or healthcare. Within healthcare, there's life sciences and medical devices. There are many specialist life sciences firms. It's a very different form of venture capital than is technology investing. Life science investing, it takes billions upon billions of dollars to get a drug to market. And life sciences, frankly, has been a graveyard for many venture capitalists trying to finance into oblivion, really, the underlying technology or research or drug, trying to get that to market. Nevertheless, when a drug is executed well and it goes through the trials, for example, in the United States of phase 1, phase 2, and phase 3, and then gets accepted by the market, the returns can be absolutely extraordinary. So you have a very bifurcated situation in life sciences where it is highly risky type of asset, but when there is a payoff, it makes you can quickly forget all the mistakes that you made. But the payoffs are few and far between. Certainly drug companies are always looking for that next great drug. They're always looking for that next technology that will drive their future sales. So they look to a lot of these technologies which are being underwritten by venture capitalists or invested in venture capitalists as possible or potential drugs and potential additions to their pipeline. But the life sciences business, again, is very capital intensive. You need a lot of capital to get a drug to market. Medical devices are a little different. In fact, medical devices are very different. Not as much capital needed to get the device to market. It can be very lengthy because of the government approvals that are needed. Usually, if you can't get what's called a 510K predicate approval, you need to go through a full PMA with the FDA, which could take years and also can be very costly because there's a lot of dollars that have to go into research that shows the efficacy of your particular device. And you never really know the outcome. There's always looking, in terms of medical devices, looking for outcomes data, etc. I invested in a company in I think it was 1994, maybe a little earlier, called Exogen. And Exogen was a brilliant technology. It was an ultrasound technology that healed fresh fractures by 40% or faster, using an ultrasound device that you would tape to that you would band around your fracture once or twice a day. And I said, wow, the idea of being able to get people back to work quicker, that's phenomenal, and getting people healed faster, that's really good, and it's non-invasive. So I invested in the company along with other venture capitalists. And I think that there was a lot of excitement about this technology. The company did go public, and the stock was very high. Of course, we were locked up. As I talked about earlier, we had, I think at that time it was at least a 1-year lockup. But the company was then challenged by a ruling by Medicare saying that they would not pay for this treatment because, for the most part, of course, Medicare patients are older, and Medicare decided that they could heal naturally. They didn't need to have accelerated healing. Well, when Medicare doesn't cover something in the United States, then the state insurance companies or the state insurance areas don't usually cover it as well. So all of a sudden, all of the insurance support for this company was withdrawn. And the stock took a huge nosedive. And as a result, I don't think any of the VCs made money. I think I got my invested capital back in that deal. But I use that as an example or as a case study to show you how so many things that you cannot foresee or that are unforeseen can impact your strategy and your vision of the future. So one of the things you always have to keep asking yourself is what if, and what happens if this happens, and of course you can go crazy doing that. But that was a sad end for Exogen, although the company was purchased by Smith & Nephew, I believe. And my understanding of, and I haven't followed it, but my understanding is that this is aligned within the Smith & Nephew medical devices, and that it's been very successful for them. So, you know, that can happen too, where the venture capitalists don't make money, but the people who buy it find a way to make money. So there's all kinds of twists and turns in any venture capital investment. But suffice to say that healthcare, composed of life sciences and medical devices, is a particular area, and there's specialist firms. There's specialist medical device firms. There's specialist life science firms. And I see this really as a growing area. I think that, you know, in terms of centers of this area, you know, the same ones. Certainly there's a lot of healthcare going on in the Boston area. There's a lot of healthcare life science companies in Israel. There's quite a few in Silicon Valley. So I think this market, and the Washington, D.C. area as well. So I think that you'll see more and more of this, although I have personally stayed away from life sciences because of just the huge amount of capital that are needed to go into science that is very, very hard to determine whether it works or it doesn't work. Within the technology area to me is more wide open. Many times people talk about, and I talk about, West Coast deals and East Coast deals. West Coast deals usually have more, if you will, risk to them. For example, although Facebook started in Boston, it's really a West Coast deal. Social networking is West Coast. Search technologies, in many ways, are West Coast. These are big ideas with big risk, and so I think that the East Coast deals, East Coast venture capitalists tend to be more financially oriented. So I see East Coast deals as perhaps, if you will, slightly more conservative, doing technologies where you see that are scalable and where cash flow can be somewhat projected. So among the technology areas in the last 10 years are SaaS companies. Chip software has been, Chips have been a very big area. Software on chips is an interesting area, very capital intensive. Technology-enabled services, batteries have been a big area, another graveyard for venture capitalists. And my own belief is that venture capitalists are best when they invest in capital-efficient deals. It becomes like life sciences. Large capital expenditures or large capital-intensive deals can be very problematic. Batteries tend to be capital-intensive because of all the research needed to get a new technology or a new battery to market. So millions upon millions of dollars have been invested in battery technology, and you see real improvements now in battery technologies. You see, Apple devices, some of them with 10-hour battery lives. That was unheard of a few years ago. But it has been a very difficult area for VC, as is any type of capital-intensive project. There's an Israeli company named A Better Place, and it's their vision to be able to service battery-operated cars around the globe. But it's a huge vision. Number one, you have to change gasoline to a battery, and then you have to change the infrastructure from that of dispensing petrol or gas to that of changing out batteries. So a huge capital-intensive project, and if it works, it's going to be unbelievably successful. But I tend to stay away from those areas. I tend to look for more capital-efficient projects. Venture capitalists are great at improving things. Venture capitalists are great at seeing where there is a problem and fixing it within a certain technology or a certain infrastructure. I think that's where we are really good. But capital efficiency is always a huge issue. Can you, with the limited capital that you can put into a company, can you make it? Can you get it to a scalable point where the technology is scalable and sold and produces ever-increasing amounts of cash flow, or where the gross margin continues to go up? Those are the real issues. So there's technology VCs all over the world in every area. I think that's the predominant area of that attracts venture capital. It's the area that I'm most familiar with. In terms of size, there are many small funds which are 100 million or less. And the larger funds tend to be over 100 million, but even within that, there's very significant bifurcation. For a while, some of the VC funds on the West Coast were taking $1 billion in commitments, or they would be taking 600, 700 million. Putting 600 to 700 million to work in an array of companies is particularly as early as a lot of VCs invest in, is very difficult. So if you were used to putting in $2 million or $3 million or $4 million, very hard to do that with a bigger fund, 600 or 700 million. So venture capital has changed over the years, given the size and the bifurcation of the market. And most venture capital funds today, in my view, are somewhere between 200 and 400 million. I think that's probably the right size for a VC fund. Many institutional investors will not invest in a venture fund that's less than 250 million because they have to worry about putting their assets to work. And if they take less than 10, if they want to invest in 10% or not take more than 10% of a partnership, then that would be a $250 million fund would be $25 million, which is really the minimum that a pension fund would look to invest. So many times the size of the fund is dictated by the institutional investor, and the institutional investor sometimes likes amounts, particularly pension funds, of over 25 million. I think a lot of that, those needs at the pension funds drove the funds to get bigger and bigger. And now you're seeing, I think, a collapse of that. I think you're seeing venture funds going back to the way it used to be, and raising smaller funds and putting out smaller initial amounts at the beginning and reserving more, given the lifeline is so long. We talked about geography, U.S., Israel. Europe is pockets in Europe are very significant. There's good pockets in France, Germany. There's some in Ireland, England. Even Eastern Europe has significant or significantly moving toward VC. Russia, which I have listed here. India is very interesting because India, of course, has a huge market of its own. So a lot of the Indian VC is being invested in Indian companies for Indian markets. And I think it's somewhat still very early for that. But both China and India and other countries in Asia have huge domestic markets. Like the Israelis, for example, have no market. They have to go out and they look to get markets in Europe, Asia, and the U.S. But in India, with over the billions of people in the population, there is a very big domestic market. So a lot of the venture funds are specific to India, and I expect that to happen more and more in China and all through Asia. In terms of stage, there's seed stage, there's early growth. That's where you have initial revenues. There's growth, which I define as 5 million plus in revenues. And then there's late stage, which means that the company is approaching cash flow break even. So let's start with the seed stage. The seed stage is, of course, very early. This is where there's a very, very high risk. Many times you see angel investors, and if you hold on one second, I think I have some kind of a chart here, and we can look through here. Here is the financing life cycle. Certainly you have a discovery or an idea and a founder, and I hope that you can see this on the computer screen. That founder will use the credit card, will use capital that he has saved. He'll borrow perhaps from family or from friends in an amount that starts getting the company off the ground. This is typically, many times, companies start in garages, or they start in basements or cellars. And they're just ideas. If you've ever seen the movie Social Network, you can see it started in a dorm room. And the friends and families were primarily the backers of it as the company began to emerge. So as the company develops, and you can see I have a proof of concept, then you need funding, and that funding starts coming in from angels or angel groups, and now we have super angel groups. That's prior usually to a VC coming in. This is still very early in the seed stage, and angels and the angel network is extremely important to venture capital. Now, who are angels? Angels could be really anybody. But many of them are former entrepreneurs, entrepreneurs who have made a lot of money and know how to operate companies, know all the issues on how to start a company and get it to a certain point. And you see many former entrepreneurs or successful entrepreneurs put capital back into some other ventures and young companies. Many times they're investors who understand this area and want to be close to companies. So there can be a wide variety of angels. But within the venture capital infrastructure, it's extremely important to have strong angels. And angels take on a tremendous amount of risk. I mean, they come in at valuations sometimes that are unsupportable. And as a result, the next guys coming in, the institutional venture capitalists, will crush them or dilute them in terms of their holdings. So angels have a very, very delicate role. It's a very difficult position. But without angels, venture capital really would not happen. It's extremely important to get an angel investment. Now, what is an angel investment? Could be, anywhere between $500,000 or $1 million, $250,000. Those are the areas. So going from the garage type of product to having a product to demonstrate, a beta, all of that is being financed by angel venture capital. And then once a product is completed and perhaps a sale has been made, then we're getting into Series A, first round venture capital. And then you start getting into that early growth area. Maybe not quite, but once you've made a sale to a third party, then you've taken or you've mitigated some of the risk in your product out because now you've sold it. And for me, as a venture capitalist, that is an extremely important step. You didn't sell it to a friend, you didn't sell it to family. You sold a commercial application to someone or some company who thought that this was a viable technology that they could use. So now venture capital is very different. We're emerging now from seed stage to a growth stage. And now that we have validation for the technology, now we can start taking that to other like companies perhaps, or other unlike companies. We can license it, we can sell it, we can do a number of things in terms of how we're going to move this product into the corporate world. So now we're getting over here towards product design and product development and venture funds. And it's the venture funds that take it from that early sale to a company to 20 companies, to 20 customers, 30 customers, 40 customers, 50 customers. The venture capitalists have created a scalable product or a scalable technology, perhaps. And now the venture capitalists may have liquidity options. They can sell it to a bigger company. Maybe this is a technology that Intel wants. Maybe it's a technology that Cisco wants. Or maybe this is such an interesting company, we can put this or take this public on one of the exchanges around the world. We don't have to be limited to the United States. We have plenty of exchanges in Canada and in Europe. So we can move this toward an initial public offering. Or maybe we move it toward an initial public offering and look to trade sale as we do that. So now you're starting to see alternatives. This is the life cycle. This is the kind of life cycle of a company that is so intriguing. Once a company develops cash flow, then the cash flow becomes leverageable. Once the company gets to a break-even point, in terms of its cash flow. It becomes much more attractive to large companies who don't want any kind of dilution issues when they purchase a company. So as you can see the cycle, sales, cash flow increasing, all of these things make a company more viable and more liquid. Because what we're striving for as a venture capitalist is to move from illiquid, and we're illiquid when we invest, to liquid. Now we've created a value. Intel's going to take us out for $50 million. Cisco's going to take us out for $250 million. They see real value in the product that you've created. And this tension between illiquidity and then driving toward liquidity is what venture capitalists do. It's what angels do. It's what everybody in this sector does, is try to invest in liquid ideas and move them forward. Now, let's discuss that a little bit, and let's discuss what is liquidity. Because liquidity is sort of an evasive thing. If I invest $1,000 in General Electric, is that a liquid investment? Yeah, because there is major market makers in General Electric stock. It trades by the second. There's millions of shares outstanding. The company is a very substantial company operating with substantial cash flow in a lot of different sectors. So if I want to buy General Electric, I can do that quickly, and I can sell it quickly because there's liquidity in the stock. There's hundreds of market makers in General Electric stock. There's absolutely no issue in getting that liquidity. Now, if I take company XYZ, which is an angel bank-backed company, it's private. It's not on an exchange. Its value is not done by the minute, by the second. If I decide to go in and I say, look, I'll give you $3 million and I'll base that on the fact that your company is $5 million. The pre-money value would be $5 million. The post-money value would be $8 million. So I'm putting $3 million on top of $5 million. Now I've made the investment. My investment is in at a post-money value of $8 million. Is that investment worth $8 million? Probably not. What's it worth? Well, it's worth what somebody would pay for it. Well, what would somebody pay for it? I have no idea, because I don't know yet how good the technology is. The technology and the investment are entirely illiquid. So much of what you see within the private equity university, but particularly venture capital, is this drive for liquidity. And the drivers of liquidity are sales, margins, scalability. And that's what makes companies much more liquid. Okay. So let's go back to our chart again on subsegments. I think we spent enough time on seed. And now, in terms of early growth, we talked about that also. This is the early growth area is where a lot of VCs get involved in. There's been a validation. There's been commercial sales. And the management team is not full yet. There needs to be a lot of talent that needs to come into this company in order to grow it. But now the fact that you have a validated company that has commercial sales, appears to be growing, has a market that is seemingly large enough to grow into, all of these make for the early growth stage and initial revenues. And then once you get to that 5 million mark, you get to the growth stage. And the growth stage is much more dynamic. You have several customers now. you have financials, you have gross margin, you have operating margin. You're starting to show yourself as a company. And then finally, late stage is a company much further along the line. You have multiple customers, and most importantly, you're nearing cash flow break even. Okay, so let's move then to economic impact. And these are just companies that I pointed out. We have thousands of companies, but I just wanted to point out that Intel, Cisco on the infrastructure side, Qualcomm, Juniper, Apple, EMC, all these are large infrastructure companies. And software, Oracle, Microsoft, Siebel, Google, I mean, all of these companies are competing. And we'll talk about that a little bit later. The internet stocks, Google, Yahoo, eBay, Skype, Facebook. I mean, eBay was also a venture-backed investment back in the mid-90s, and then it just absolutely took off. In healthcare, Amgen and Genentech certainly you have to point to as being venture capital, life sciences companies that become huge companies now that have made tremendous amounts of money for their investors. And then services, too, that I just pointed out was FedEx and Staples. So I hope that's good for the first segment. We have a lot more to talk about, and I look forward to speaking with you very shortly. Thank you.